Good morning, everybody. I'm Brent Guimond from the Review Art Center. We're back again this Monday with John Maisey. Morning, John.
Good Monday morning, Brent. How are you?
Fantastic. How about yourself?
We're doing very well. Great to see a little bit of liquid sunshine for the next day or so.
Yes.
Rains everything up.
For sure. Needed it for sure. So today you're going to be talking about some investment, diving into a little bit of mutual funds, just because it's kind of like the biggest form of investment in Canada.
Yeah, one of the most widely held investments for most folks are something called mutual funds. So I thought it'd just be good to kind of get into that and kind of give an overview as to how they help minimize risk for people. So we'll take a look at that. Okay. And compare them maybe to a couple of the other assets that are out there that people may be familiar with, like exchange traded funds or ETFs and stocks. So I thought we'd spend a couple minutes on that. So with that, I'm going to share a screen and kind of go over one of the reasons how the mutual funds work, and then we'll look at a couple other things as we go through, and we'll get going. So when we look at mutual funds, there's many different carriers. I just happen to grab Dynamics Global Asset Allocation because it's basically a balance fund. So I just wanted to spend a minute on that. It's not that I'm recommending Dynamics specifically. It's just I like the layout of their page because it gives a lot of different things here. So with this, before I get into this part here, I'm going to scroll down a little bit and look at where your money goes if you're investing into a fund like this. So what happens with a mutual fund? We've all heard the expression, don't put all your eggs in one basket. So if you drop that basket, you break all your eggs. Well, the idea with a mutual fund is it does that for people. Most people would like to participate in the stock market. The problem is the average purchase and sale is quite costly to do. You could be paying anywhere from $10 a trade up to $30 a trade. So if you've only got $100 to put into an investment on a monthly basis, if you're buying, say, a bank share in RBC, you'd have to go to the market, you put a bid up, and you've got to pay. We'll take a conservative one, $10. Well, now you don't have $90 to work with anymore, or 100. You've got 90. So it kind of limits what you can do, and it's hard to diversify that into two banks because the trading fees are there to hurt you. So what happened was somebody developed something called a mutual fund, and it was a company by the name of MFS out of Boston in the late 1800s. Their office now overlooks Fenway. I've actually had the pleasure of being there and seeing the very first mutual fund book that was opened up. It's kind of neat. It's all handwritten in beautiful calligraphy ink. But what they did was they said, okay, let's take 100 people, and the 100 people put $100 a month in. So now I get 10,000, and we're going to hire somebody that's job is to only look at stocks and bonds and make purchasing decisions on that with a lot more advice, because the average person is an expert at what they do, and what they do typically isn't trading stocks and bonds. So you may very well be very good at managing the Review Art Center. But when it comes to figuring out what's the best strategy for your $10,000 may not be the best. So what happens is with that, they turn around, take that 10,000, and now they're purchasing, and that $10 fee is divvied up amongst the 10 people that's there. So it doesn't hurt as much, and it's done on a much bigger scale. So the other thing that happens with it is the fund manager, which is what we call people running the funds. The fund manager turns around and further diversifies it. So he gets a whole bunch of baskets. So first one he looks at is asset allocation. Where are we going to put your money? So in this particular one here, and I do apologize, this might be a little small, so you can make it a little bit bigger. Hopefully that zoomed in. Nice. So in this particular one here, he's got 31% in cash right now. So he's a little concerned with what he's seeing going on in the market. So he's sitting on some cash to take advantage of the volatility. He's got 33% in U.S. stocks, 32% in something called bonds, which are debt obligations or loans that they lend money to people and then they get interest on it. And commodities could be gold, could be oil, those type of things. Doubtful very much it's oil right now. It's probably gold that they're sitting on there. And then they turn around and they say, okay, where are we going to divvy this up? So basically it's in thirds. They come in, and to no surprise, the biggest holdings are broken down geographically. The biggest holding is typically in the United States because they tend to be the economic engine. You're going to start to see this number shrink a bit over time. In my opinion, you're going to see a lot more coming out of Asia, just as China becomes the juggernaut that it once was historically. Switzerland, there's a fair amount in here in Switzerland. Then we get Japan, Israel, France, UK, Canada, Netherlands. And then once they've just determined, where they're going to put your money, then they turn around and say, okay, out of these stocks, we're going to do something called sector allocation. So first of all, they figured out, okay, I'm going to put 30-some% in stocks. The next part would be the sector allocation. This kind of comes in last. Sector allocation, they're saying in this particular fund, 25% of your money is going into IT. So that could be the FANGs, Facebook, Alphabet, Netflix, Google, those type of things. Healthcare, it could be people developing vaccines, those type of things. You'll see companies like Pfizer, Johnson & Johnson in there. Consumer discretionaries, that tends to be more electronics driven, things that you tend to buy once in a while, like a new television, that type of thing. Industrials, a lot of manufacturing materials, consumer staples, things that people use every day, and then financials. So this particular manager here doesn't have a high regard of financials because he's got very little of them. So then we look at his top holdings right now. So when you put your $100 in here, you're own part of a company called Lululemon, which most people have heard of. But there's a lot here that most people haven't. Humana, you may have. Amazon, pretty much everybody has. Yeah. But he turns around and he's got it very well diversified. So that $100 going in there, you're ending up purchasing, fractional shares in hundreds of companies, versus having to figure out, where would that $100 be best served in one particular share. Mm-hmm. So with the example I often use is on payroll with the company that sponsors my license. I'm self-employed. They do have one little perk that if I put money in their shares, they match it up to 50% to a whopping $1,500 a year. From 2000 to 2008, I'd accumulated 300 shares worth $15,000. Those 300 shares in January of 2009 were worth $4,500 because it was the financial crisis and financials get hit pretty hard. These particular funds wouldn't have got hurt so bad because they were diversified. They weren't down 2/3. They were down slightly less than that. This one here, I have to find performance. Yeah, he hasn't quite been around as long, but he's mitigated most of that. So that's how a mutual fund works. It diversifies. Now the other important parts on mutual funds, I'm just going to move you guys over here a little bit. You often hear people talk about the management expense ratio. So what are we paying the manager? So in this, the management expense ratio is 2.41%. So that means out of $1,000, $24.10 went to the manager over the year to manage that money. How that's broken down is half of it goes to what they call a dealer. So in my case, the company that sponsors my license gets paid 1%. The other 1.4 goes to the manager. Out of this, though, probably 0.3% is HST, because the government, in their wisdom, thinks it's a great idea to charge HST on this stuff too. Because the net fee down here is like 1.9, but that's why it goes up 2.41 because of taxes. So when we look at returns, if in 2019 I said this fund made 14.9%, that's net of fees. So when we look at it, that 2.41 should have been on top of that. So we were at about 18% roughly in this particular fund, 17%, somewhere in there. 17.5% was what this fund would have made that year. But it's the fees. So a lot of times you'll hear ETFs will come out and say the fees on mutual funds are very high, which they can be. But at the end of the day, the fees are somewhat irrelevant. And why I say that is the fees, like, Brant, I'll give you my wallet right now. And if you can double my money in it, I'll give you half of what you made me. I will pay you for performance. So if you can net me out 50% after fees, I really don't care what I paid you. Where it becomes important is that there's different versions of the same fund, and one has a lower fee structure than the advisor should be giving you the lowest cost version that's available at the time. Now, a lot of the fund companies now, what they're doing is they're automatically changing the fee structure once you hit thresholds. So if you hit $100,000 in net assets, you'll get a break. Once you hit 250,000, you get another. 500,000, you get a bit of another. But that's how mutual funds work. Does that give you a little better understanding of how it's diversified?
Yeah, for sure.
Yeah. So now the difference between this and an ETF, a lot of the ETFs follow something called the index. So the index, and I'm just going to stop sharing here for one moment, just because I never thought to bring this one up. But an index, what it is and this is actually a good topic right now. An index mirrors something that's widely reported for the most part. So if we look at the Dow Jones, which is one everybody's heard of, the Dow Jones has gotten beat up pretty bad here over the last few months because of the COVID.
Mm-hmm.
So when we look at the Dow Jones, most people are quite surprised when they call in to see, where am I? So I'm going back to share here. Like, how am I doing? The markets are off 40%, and they were quite surprised to find out they might have been down anywhere from 10 to 15%. And they go, how come I wasn't down 40? But you don't own the index. They only report the index. They don't report every particular fund. So that's one of the reasons why we run into that. So when we look at the Dow Jones index, these are all the companies that are on here. Like you've got 3M, American Express, Cisco, all the names you know. Walt Disney's been beat up a little bit because they own some cruise ships. There's a lot of companies on here, like Nike got beat up a little bit because nobody was able to go out and shop and buy. There's a lot of companies that did okay on here, but when you look solely at the index, it wasn't. They weren't all winners. So an ETF though holds pretty much the index or whatever they're tracking, so they don't have any latitude to veer away from this. Where a mutual fund, depending on the mandate of the mutual fund, the manager has a lot of latitude. So you'll hear them say, I'm 98% different than the index. That means 98% of his holdings are different than what's on this sheet here. So that gives them the opportunity to diversify more. And what happens with a lot of the indexes, like Canada's has got the top 60 companies, S&P's 500, Russell 2000, I'll give that a little bit more merit because it's a little bit more diversified. But ETFs tend to follow this, and they don't have the latitude in some cases to veer away. And when we look at individual stocks, like if you would have looked at and pick on Air Canada for a second, I'll just stop sharing this. Air Canada, you can debate the merits of its customer service. I think when you're that big, you're going to have some problems, and with social media, you're going to hear a lot about it. But if I'm flying and I'm stuck somewhere overseas, I'd rather be dealing with Air Canada as a carrier than some of the others because there's more options. But Air Canada shares because flying get grounded. Right now, I've had, I think I'm up to 9 flights canceled. So that really dramatically impacted their company, their worth. So the Air Canada shares right now have just been beat up. So if you're going individual stocks, if you had all your money in Air Canada, for example, you had something that was trading in the 30s that had went down as low as like $6 or $7. So the idea is diversification, and that's part of the reason that's important. The other thing I wanted to point out when we're talking about mutual funds, and mutual fund companies are great for research, and I forgot to hit share. I'll get you back up here for a second. They've done a lot of research, and the other thing that's important when you're dealing with investments, whether it's stocks, ETFs, or mutual funds, is to find an advisor that will give you appropriate advice. So when we look at advice, what's the difference for people? So at households who work with a financial advisor, their saving rate is substantially higher than those who don't. So they tend to save, 4% more money, which, 4%, 6 to 10 doesn't look that different, but on a percentage-wise change, it's huge. The other thing that happens is the longer you work with an advisor, the more money you have. So, if you've been working with an advisor for 4 to 6 years, you have 1.7 times more money than someone who hasn't. Over a 15-year period, you have 4 times more money. And one of the reasons is right now, where we have volatility in the market, people have to call me to find out what to do with their investments. Should I sell? Should I go? What can we do? And a lot of times it's just, we've done the example with the blinders, is just to remind people about the blinders, and this too shall pass. And because you're doing it with an advisor, you've got that sounding board where if you're doing it on your own, you might actually hit that sell button on the computer. So, you know, the big thing with this one, this is a dramatic difference to have 4 times more money versus somebody who's trying to do it on their own. And so what if the advisor got paid, you know, the advisor and the dealer got paid 1%? You know, if you had 100,000 here and this is worth 400,000 and you happen to pay somebody, you know, a couple $1,000s a year over that period of time, but you manage to come out 4 times ahead, I'd be okay with that. I don't know about you, but I'd be really okay with that. So that's the value of advice, and a little bit about what mutual funds are right now. Mutual funds can be further broken down by flavors, I guess is the way I put it. The most common is a balance fund, but you can do sector funds if you wanted. I tend to stay away from that. I tend to be somewhat boring because the expression is less plus less equals more. Less returns with less losses make you more money in the long run. But you could be in an oil and gas fund. You could be in a technology fund. You could be in an emerging markets fund. It's hard to pick which the winner is going to be every year. But when you've got professional managers and the guys that manage the money for us, if you were to meet them, you know, there's some of the, I'm trying to think of the politically correct way to say, bookworms, I guess, as well. But all they do, their passion is to study the numbers of the companies and to do that type of thing, and they absolutely love it. So we let them do what they do. My job as the advisor is to figure out what you're looking for, find the appropriate solution. The solutions provider's job is let me know if there's any major changes in philosophy or strategies. I then have to reevaluate to make sure it's going to do what you want it to do. And then your job is, if there's any major changes in the household, to let me know. So for example, you hit those magic 7 numbers on a Friday night, well, the way we're managing changes a bit. Or if all of a sudden, you know, you're going to be getting married and having 2.2 kids, that's a change. Or conversely, if you have the marriage and the 2.2 kids and you're going to go down to a single with supporting 2 kids, that's something we need to be aware of because it changes the way we do things. So I'm hoping that's a better overview for everybody for how mutual funds work and the benefits of them and the diversification. So I'll let you see if there's any questions or we've covered it off.
Anything else here from anybody that's in? Daniel, do you have anything? No? Okay. Well,
nope.
Anything else from you then, John, or?
No, I think that's it. If as usual, if from a disclosure point of view, www.maiseyfinancial.com. If anybody's looking to get a hold of me, just reach out. Best advice is to reach out to your advisor. And remember, it's not about what you make, it's about what you keep.
Awesome. Thank you. And we'll see you next Monday, guys.
Pleasure.